Didier Duret, chairman of Omega Wealth Management. Thanks for joining us this morning on what's turned into quite a difficult start for European markets and a steep sell-off in the U.S. yesterday. What do you pin down this sell-off to?
Good morning, Juliana. I think the sell-off is a natural reaction after what has been announced with the Fed minutes. I think a dose of prudence is necessary on the short term. We have seen a stellar performance when it comes to equity price. Earnings also has been totally extraordinary, but we are seeing many peaks around. We see a lot of huge divergence between developed market, emerging market, within the Fed, between the oaks and doves. And this is really creating a form of policy uncertainty. So it's a natural correction, but this is not the end of the world. I think first thing, it's favorable, this uncertainty for US dollar, because divergence and higher uncertainty reinforce the safe haven status of the US dollar, and it gives a positive undertone to the US Treasuries. But, you know, this is not the end of it. It doesn't mean that because we see many peaks, it's the end of the recovery. There are still plenty of room to enter, and we are still in a bull market. It's simply a correction phase.
I want to get into what all this means for portfolio allocation in just a moment, but I'm curious what exactly was new in the Fed statement, or the Fed minutes rather, yesterday, given plenty of analysts and economists were already expecting a taper announcement to come in September and for tapering to begin by the end of the year. So what exactly was new for markets?
I think what is new is simply that it's really painted in on the wall. That they are entering into a prudential mode. It's no more emergency mode for the Federal Reserve. It's prudential mode, and they want to really prepare the market for the tapering, which is the first phase of normalization. And I think the jury is still out. There are many uncertainty around. If you look at the topics for the Jackson Hole, it's economic policy in a diverging environment. So I think it says it all. I think what has changed is simply the fact that there is, let's say, an outright recognition that we need to have a more balanced policy.
All right, so let's translate this now into your portfolio approach. I see that your main call is overweight European equities, and this is interesting to speak to you today because yesterday we spoke to the head of European equity strategy at Bank of America, who recently downgraded his view on European equities from overweight to neutral on the basis that he doesn't see any more upside to European equities for the first time since Jan 2020. So I'm curious why you think there is upside to European equities and what's going to be the catalyst for it.
It's mainly a relative risk perspective that we are taking at Omega Wealth Management. I think, first of all, Europe has been in a value trap for many years, if not decades, okay? And we are seeing, first of all, GDP advancing at a 4.5 handle, which is totally extraordinary because the trend growth in Europe is about 1.5. We see lower risk and well-rewarded risk in Europe, because simply if you look at the yield of the CAPE, Europe is 7.2, which is more than double the CAPE yield that you have in US, 3.2. So you have a risk premium that is strongly embedded into European equity. And I think also the composition of the European markets present diversity. And that's one of the elements. Additionally, in Europe, we have a much lower correlation between the stocks than in US. In US, it's already very low. It's about 20%. But in Europe, it's 12%, meaning that the companies are priced on their own merits and on their own growth perspectives.
Didier, so very clear where you think the biggest opportunity is. I'm curious how you think about hedging in this environment. We were just looking at the price of gold this morning relative to the dollar. We're seeing a strong bid for the US dollar this morning on the back of this risk-off move, but gold is actually trading about half a percentage point lower this morning. So what are your preferred hedges, and how do they fit into your broader portfolio approach?
I think let's say the traditional hedges or tail hedge, such as the VIX or put buying or gold, will not work, or not even U.S. Treasuries. If you look at the U.S. Treasury correlation versus the S&P, it's back to zero. It was minus 50 a few months ago. So we are in a situation where we need to look alternative hedge instruments. For instance, in the currency market, having position in yen or Swiss franc will be interesting because they are trading at the bottom of their range. Also very interesting is to look at macro CTA portfolios because the macro CTAs play well trends after the peaks, and we are facing a multi-peaks environment. So this is why we need to think about alternative hedge and not the traditional hedge.
Didier, lastly, now that the FOMC minutes are behind us, everybody is looking to Jackson Hole. What are you going to be looking out for? What do you think we could hear from central bankers at that all-important symposium?
I think it will be a reinforcement of the prudential mode and recognizing that inflation is not, let's say, an average inflation, generalized inflation problems, recognizing the difficulty of policy setting. So that's probably the radio mood we should hear from Jackson Hole. But also we should remember that many policymakers from Europe and Asia will be invited to this forum. And we might hear interesting comments also, for instance, from the Bank of England or the ECB.
All right, Didier, thank you so much for joining us and helping us make sense of these pretty dramatic market moves. Didier Duret, chairman of Omega Wealth Management.